Hello Internet and welcome to a special edition of 1 Minute Answers from 1 Minute Economics, an edition with a lot of guests. First and foremost, we have of course our human guest for the week, who is going to be Mike from the CommonCentsMike YouTube channel. Mike specializes in topics related to personal finance and specifically debt optimization, and he has been kind enough to hop on board and answer your questions as well. Our animal guests, on the other hand, are Tina the pony. We're also going to have lambs, chicken, perhaps a pig in the frame occasionally as well, so it's going to be interesting. We are filming this at our in-laws, and we've actually filmed another video here before. I think it was the second 1 Minute Answers from 1 Minute Economics video. So with that being stated, I think we can move on to the questions, but not before picking the topic for next week. And the topic for next week is going to be isolationism. I've picked this topic obviously in light of the fact that internationally speaking, a lot of stuff has been going on. For example, the decision of the United States to exit the Paris Accord. Then there was also the G7 and NATO reunions with all sorts of political implications as well. So if you have a question about isolationism, about the consequences of isolationism, about the pros, about the cons, about anything at all related to isolationism, simply ask me by writing a comment below, and I will be answering your questions next week. For today's first question, Dan would like to know if it's a good idea to fund a new business if you have confidence in the idea and if you've done your research. Now, I've done a lot of stuff online and enough to know that there's a huge difference between having an idea you consider good and actually executing, actually turning that idea into a business that produces revenue. So with that stated, I'm going to ask you 3 simple questions. The first question is this: is the business in question going to be able to produce revenue relatively quickly? And I'm asking this because there's a huge difference between starting, let's say, a web development business that's going to produce revenue right away and starting, let's say, a forum which you have to get off the ground first and only then will start making money. So it's important to know just how soon you can expect your business to be producing money. The second question is, once again, simple. Are you the only person that you are financially responsible for? Because there's, again, a world of a difference between someone who is perhaps just fresh out of college and doesn't even have a girlfriend and someone who has a family to feed. And this dimension of your existence also needs to be taken into consideration when deciding if you're going to start a business on debt. And finally, the third question is, if the amount in question, the amount you need for your business is fairly small. Because once again, it might not be the best idea in the world to be crippled by debt and to be taking on debt to, the absolute limit when you're starting a new business, especially if you have no experience whatsoever when it comes to running businesses, which is probably the case. So I would say that if the answer to all 3 questions is yes, then funding a business with credit card debt may be a decent idea. Because in the world of business, you do have to take risks, and I'm not here to encourage my viewers to be Chicken Little. However, if the answer to those questions is not yes in all 3 cases, then perhaps it would be a good idea to rethink things a bit.
Hey guys, my name is Michael. Thanks for your questions. So first off, Andre, thanks for allowing me to do this. I really do appreciate it. So I know I need to answer your questions in a pretty fast fashion, and I'll try and do my best to do that. Dan, you had asked, is it a good idea or is it okay to go into credit card debt for a business idea that you've thoroughly researched? And my immediate answer would be no. But I'm going to ask you this. How likely is it that even if the business doesn't go according to plan, that you can recoup at least your initial investment? If it's something that I'm guaranteed to at least get my money back, then that's a little bit different. Otherwise, I would probably say no, stay away from it, because you never know what's going to happen. If things don't go according to plan, well then you're still going to be stuck paying that interest. Now, maybe you should go talk to a commercial bank and see if you can do a small business loan. Maybe crowdsourcing is a way you should go, but I would not recommend credit card debt as a means to fund a business idea. Maybe, if it's $500 or $1,000, something really low, and you'll get your money back, maybe, but outside of that, I don't think so.
The second and final question for today has been asked by Ivan, who would like to know how much debt is too much as a percentage of your income. Now, to answer that question, I'm going to go from best case scenario to worst case scenario. And I'm going to do this because there are, of course, lots of variables involved, but perhaps more so than anything else, it all depends on the nature of your income, on the nature of what you do for a living. So I'm going to start with the best case scenario, which would involve perhaps you having a well-paying job in a field for which there is a lot of demand. So therefore, on the one hand, you make a lot of money. On the other hand, even if you do lose your current job, you're going to be able to find a new one in the same field relatively quickly. Whereas the negative scenario would be perhaps you having a bit of an esoteric occupation, or in other words, a job for which there is maybe just one employer in your region. So if you end up losing that job for whatever reason, you might be forced to, one, spend a lot of time hunting for a new job in the same field, or two, you might even have to go through a career change, and that can be financially debilitating if you have high levels of debt. So obviously my advice to someone from the first scenario who has a well-paying job in a field for which, there's a lot of demand for his skills, my advice for him is going to be a lot more aggressive than my advice to someone who is dealing with the second scenario and who is, as such, more financially vulnerable. I think the name of the game is putting together a strategy based on your specific situation. And another word of advice I have is this: when making plans, always be pessimistic. So what I think you should do is the following. You should take a look at your current situation, at the current nature of your income. Then you should try to think of a few pessimistic future projections. And if the numbers make sense, even under that pessimistic scenario, then I think it's fairly safe to say that your strategy is probably decent. If they don't, then the prudent thing to do would be going back to the drawing board and only being willing to make debt-related decisions if the numbers make sense under pessimistic scenarios. So that would be my 2 cents on this matter.
Ivan, you had asked, what amount of debt should you have in proportion to your income? And I would honestly say that there is no such number. I would actually never try and keep my debt based at a percentage of my income, mainly because your income isn't guaranteed, right? You can always change jobs, that your salary could go down, it could go up. If you say, all right, well, let's keep it at 30%. Well, what if you buy something, a car, a house, whatever it may be, when your income's at, $100,000 a year, but due to unforeseen circumstances, you lose your job and you earn half as much. Well, now, because of your salary change, your debt is far higher percentage-wise. So I'd actually never allow income to dictate how much debt it should be okay for me to have. What I would actually suggest is dictate a few guidelines when you're buying something. First off, as far as debt goes, never have unsecured debt. Things like line of credit, personal loans, credit cards. Avoid that stuff at all costs. Have 0%. Second, if you're buying a car, try not to buy any car that you cannot put 50% down. Yes, 50% down. Okay, and that means if you're making good money, well then you should have a lot of money to set aside for a down payment on a car. Right, so 50% down on a car, that would be my rule of thumb for that. And then lastly, for a house, don't buy anything where you can't put more than 20% down. That way you don't have to pay mortgage insurance and you're saving money every single month by not having that extra payment. So that's what I would recommend. Thanks again, Andre. And guys, if you want to check out my channel, Common Sense Mike, I just try to talk about all things personal finance, but thanks again for your questions.
That's it for today, guys. Thanks a lot for tuning in to yet another edition of 1 Minute Answers from 1 Minute Economics. And of course, a special thanks to our human friend, to Mike from the CommonCentsMike YouTube channel that I'm going to link to and that I invite you guys to check out. Mike's great at anything that has to do with personal finance, specifically with issues such as debt optimization that we've covered today and so on. Again, be sure to check out his channel. A special thanks to Tina and our animal guests as well. And I truly hope you've enjoyed today's edition. Now, before ending it, I want to remind you guys that the topic for next week is isolationism. So if you have a question about the effects of isolationism, about isolationism in general, about perhaps a recent event in the sphere of isolationism and so on, then simply ask me by writing a comment below, and I'm going to do my best to answer your question next week. As usual, please like my videos, comment, be active in the community, subscribe to 1 Minute Economics if you haven't by now, and of course, if you can, head on over to 1minuteeconomics.com where you can find more info about how to support the channel financially as well. Thanks a lot, guys, and have an awesome weekend.